Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Third Coast Bancshares Inc. Annual Report. Third Coast Bancshares Inc. offers a wide range of financial services to its customers. At the core of their offerings are commercial banking solutions tailored for small and medium-sized businesses as well as professionals across the United States. Their deposit products include checking accounts, money market accounts, savings accounts, individual retirement accounts, and certificates of deposit. On the lending side, they provide a variety of loan options such as commercial real estate loans, residential real estate loans, construction loans, development loans, industrial loans, farmland loans, consumer loans, agricultural loans, lease financing, and bond anticipation notes. In addition to traditional banking services, Third Coast Bancshares also offers digital solutions including retail and commercial online banking platforms, mobile banking apps, treasury management solutions, merchant card services, and customer digital solutions. They also issue debit and credit cards for their customers' convenience. Their investment portfolio is diversified with state and municipal securities, mortgage-backed securities, agency collateralized mortgage obligations, U.S. Treasury bonds, and corporate bonds. With a strong foundation established in 2008, Third Coast Bancshares has grown to become a prominent player in the banking industry, headquartered in Humble, Texas. The stock price of Third Coast Bancshares, Inc., has experienced a significant increase of over 17.1% in the past year due to several key factors. One major contributor was the company's strong financial results, particularly in the second and third quarters of 2025. In Q1 2025, Third Coast Bancshares surpassed earnings and revenue forecasts, reporting an EPS of $0.96 and revenue of $52.02 million. This positive news led to a 2.15% increase in the stock price. The company's strong performance continued into Q3 2025, with an EPS of $1.03 and revenue of $54.48 million exceeding expectations. Additionally, Third Coast Bancshares announced a merger agreement with Keystone Bancshares, Inc., which is expected to create a combined entity with over $6 billion in total assets. This strategic move was viewed favorably by investors and contributed to the stock price increase. The company's record financial results for Q4 2025 and full year 2025 further boosted investor confidence. The full-year net income reached $66.3 million, marking a 39% increase year-over-year, and diluted EPS hit a record $3.79. These positive earnings surprises, coupled with the successful completion of the Keystone Bancshares merger in February 2026, have collectively contributed to the sustained increase of Third Coast Bancshares, Inc. stock price by over 17.1% during the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline in a financial institution are multifaceted and influenced by various internal and external factors. Revenue growth is primarily driven by organic expansion, strategic mergers and acquisitions, and technological advancements. The ability to compete with larger banks through personalized service and relationship-driven approach also contributes to revenue growth. Additionally, the adoption of artificial intelligence and regulatory environment play a significant role in driving revenue growth. On the other hand, revenue decline can be attributed to several factors, including inability to sustain revenue and earnings growth, negative public opinion, credit risk from counterparties, reputation issues with targets management, integration risks from acquisitions, disruptions from climate change, and reductions in regional and local economic activity. The net income of the company underwent a significant change between 2023 and 2025. Initially, it decreased from 2023 to 2024 due to various factors such as changes in interest rates, loan growth, or operating expenses. This decline was further exacerbated by potential credit losses from commercial and industrial loans. However, the net income increased from 2024 to 2025, indicating a reversal of fortunes for the company. The reasons behind this increase are not explicitly stated, but it can be inferred that the company managed to mitigate some of the challenges faced in the previous year. The profit margins of the company also underwent a change during this period. They were compressed due to increased interest rate increases, reducing net interest income. This was further compounded by the potential loss of low-cost source of funds, if customers transfer money into other investments. Additionally, the profit margins may have been negatively impacted by increased expenses from regulatory scrutiny and new regulations. Overall, the changes in net income and profit margins can be attributed to a combination of factors affecting revenue, expenses, and other aspects of the company's operations. The company's operating cash flow has been a subject of concern. In 2023 and 2025, the company experienced negative operating cash flows, indicating that it was not generating sufficient funds from its core operations to meet its financial obligations. However, in 2024, the company managed to turn things around and reported a positive operating cash flow of $15,439. This suggests that the company has made some improvements in its operational efficiency, but more work is needed to sustain this trend and ensure consistent profitability. The company's debt level and interest expenses have undergone significant changes over the past few years. According to the extracted summaries, the total debt has increased from $111.6 million in 2024 to $118.8 million in 2025. However, there are some fluctuations in specific types of debt, such as FHLB advances and line of credit senior debt, which have decreased. Regarding interest expenses, the information is conflicting across different pages. Some sources indicate a decrease in interest expense, while others suggest an increase or no significant change. Specifically, page 49 states that interest expense decreased by $9.4 million, 5.2%, from 2024 to 2025, but page 87 reports a decrease of only $630, $7,617 to $6,987 in the same period. Overall, while there are some inconsistencies in the data, it appears that the company's debt level has increased slightly, and interest expenses have undergone some fluctuations. However, the exact nature and magnitude of these changes remain unclear due to conflicting information across different pages. Management is cautiously optimistic about the company's outlook, citing its strong footprint in existing markets as a key driver of continued growth. The bank's capital remains robust, and it has invested heavily in IT systems to enhance capabilities and customer experience. However, management acknowledges various risks and uncertainties that could impact earnings and growth, including environmental liabilities, intellectual property claims, and cybersecurity breaches. To mitigate these risks, the company is focused on maintaining a strong risk management culture and growing organically through de novo branching, as well as pursuing strategic acquisitions. Management also emphasizes the importance of a robust culture and inclusive workforce in driving success. Despite concerns about potential risks, the company remains committed to its growth strategy, which it believes will position it for continued success in the markets it serves. Overall, management's outlook is characterized by a balance between caution and optimism, reflecting both the opportunities and challenges facing the company. By managing risks and investing in strategic initiatives, the bank aims to drive long-term growth and success while maintaining its strong financial foundation. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, one notable transaction was with Keystone Bancshares, Inc., which was completed on February 1, 2026. The total aggregate consideration for this deal was approximately 2.6 million shares of common stock and $20 million in cash. The company has also expressed its intention to pursue strategic acquisitions of financial institutions and other complementary businesses. Furthermore, it is possible that the company may issue shares as consideration for future acquisitions and investments. In terms of divestitures, the company has discontinued several interest rate swap agreements, resulting in significant gains. Between April 2024 and May 2023, the company recognized a total gain of $16.1 million from these transactions. Based on the available information, we can conclude that the company has a history of paying dividends, but only on its preferred stock. Unfortunately, there is no evidence to suggest that it has paid dividends to its common shareholders. Furthermore, our analysis reveals that there are no clear indications of share buybacks by the company. That concludes the financial summary for Third Coast Bancshares, Inc. Feel free to comment below, and I will be happy to answer them when possible.